Let's move on to the conversation around the return on cost, cap rate, and back to that development conversation on buying even the B properties and looking at the developers even building it for perhaps even the same time. You mentioned like never in your history have you seen B property trading at these terms. So what are the metrics that you're looking at? Some people trade off of price per unit. Does that matter to you? I guess
it now more than probably ever. I mean, it always matters. I mean, specifically where we're focused right now is we believe that we can, when everything's trading and it's constantly just raising the price per pound of what people are buying for, what that's also doing is it's locking in their rents because it's locking in these debt service coverage ratios and it's locking in, we're basically, I'm always worried that if we get in a competitive market, what happens? People lower their rents, the occupancy goes down, and you start go down this down train, like who can drop further? It's really interesting now that as you see things trade around 300 a door, 350, 400, you'll see deals trade for 500 this year in Scottsdale, that when you can replace that for less, it's hard. I have to go there, right? Like I have to go there and then I cheer them on because now if you're getting $1.70 per square foot rents and you bought that at a 1.3 debt service coverage ratio and you spent $320 a door and I can bill for $250 a door, and my product is going to be 20 years newer, and now the market turns, and now we're competing on product, I like my position, right? Like I can buy those rents, I can buy your renters, in theory, right. That type of thing. So we're focused on finding land, doing those type of deals, and we're still underwriting tons, looking for more, but that's usually where we're tapping out is that delta of what you can build it for and what you can buy it for is just getting too large that I can't justify it yet. So,
and what are those factors in that marketplace? I mean, the obvious rents, employers, fixing your debt.
Yeah, and you look at a lot of spots around the country, you could actually have a cheaper mortgage payment than you are paying rent right now. Mm-hmm. I think that's where it gets into the whole renter by choice dialogue and all of that. We want high constraint, like tough markets to build in. We've been a tertiary developer, so we're up in Prescott, like we're up in Flag. We're looking at Tucson, it's not tertiary, but we like those niches where you look and you go, gosh, the house there within a mile or 2 mile radius is $600,000-700,000.
Right.
Their mortgage payment. So if they come up with 20% and they could put all these financial things together to go buy the house, like one, they should, right? That's absolutely great. But there's a huge delta to live there and to take care of and to have all of these amenities, right? Because it's going to turn happy hour somewhere, and right. So if we're in a spot that allows people to participate in the amenities of whatever that city or whatever has, then we like that. So we have on the operations side, we work with a lot of developers. So we have urban, we have so each one has its specific niche. But for what we're doing internally is we're looking for product that we might not ever sell. We will build it if it goes well. We would like to actually own it because they're too dang hard to sell, right? We just sold one and it's like huge remorse because you're like, oh, I just spent 4 years on that thing of every detail of every light switch. And then and don't get me wrong, you get paid, but it's emotional, right? And so as we continue forward, what we learned on that is we have to develop product more that we feel can give us more of a competitive edge further along down the line.
And you did this when it seemed secondary market,
right?
Yeah.
Yeah.
So was that an easy choice to make to develop at that time?
No, it was. I mean, it was difficult on the debt. It was difficult on. I mean, if you think about it, like because there was no data around it. You would go and you would watch a house on Craigslist rent in a matter of hours for $3,000, and it's an older house, and you would just hear about how tight this market is, and no new supply had been built there in 10 years, and then you go through, well, how are we going to get subs, and all this stuff, and it's just there's a lot of problems on it, but we were able to solve those, and it was great. So on that particular project, we developed it. We thought we'd have an NOI of $1 million. We had an NOI of $1.7 million. So we way underestimated the market and the demand because there was no type of data. And so, but it worked
at $1 million.
All day.
Right.
Because the land was there. We were saying, hey, at $1.40 rents, we are so competitive in this market, meaning we could pull residents from other places, from deals that had traded. And the same situation happened where the older product traded right before we pulled the trigger because I was getting cold feet, right? Because you're like, I'm crazy. What am I doing? So they traded at a price per pound that locked them in. And that literally, that instant on that one deal is what gave, because you have to kiss the paper, right? Those are full recourse.
Does it ever feel good going in like
no, no.
Is that why not everyone's a developer?
No, it does not. It does not.
And meanwhile, everyone, the larger investment firms are going more after the yield, right? So isn't that an attractive purchase on the sell side?
Yeah, I mean, their velocity. We have made a lot of offers because I thought, again, I didn't think a lot of people were tracking this cap rate delta, right? Class B to Class A, and so all of a sudden I'm like, Class A is the buy, right? Because eventually the equity is going to figure all this out, and they're going to all go to the Class A, and they're going to compress They're going to compress the Class A cap rates. That was our guess, and so these developers that were in construction. They're literally, I mean, people have figured it out. I mean, they're selling deals on pro forma rents right now. Now, I would argue that the pro forma rents are low, and maybe that there's a buy there. But you have the merchant type builders who are just high velocity, right? They're going as fast as they can. They're getting slowed down. They're getting slowed down from trades, and just that's the biggest issue. But they're developing it to exit it, to sell it quickly, right? Their feet, like it's going. So this is just a different deal. So it's not too exciting the first 2 years, right? Because there's no yield, there's no cash flow, there's no nothing. But we think that we get rewarded on that at the end.
Yeah, and how do you structure that in that period of time where you're not generating the rents? How do you hang on, I guess?
Yeah, so you capitalize it correctly. So we have really good banking partners. The equity, we structure it so, because you need the equity because the bank burns through the equity before they burn for the debt on the construction, and so we do a preferred return while that's going on, and you kind of play with the market of what the market is seeking, for that in order to have the equity player go in. But when we were going into those markets, I literally flew up one investor, and I'm like, just tell me I'm crazy.
Yeah,
right? Tell me I'm crazy. And we went through all the fundamentals, just old school real estate fundamentals of supply and demand. Like it was really that. And here's what, if I'm walking around with $1,200 rent, where do I go?
Right.
And it was like, we could do this, and this will make a lot of sense. And, that's what happened, and obviously went way better. But, those type of markets are just, it's a little more difficult pitch.
Yeah. How involved were the investors? Are they completely passive, or they get involved into the story of everything as well? Or
I like them to be extremely involved from the story. On the development one, the investor there was much more involved. On a typical, other one, they're much more passive. They're, hey, we communicate on the quarter. They want to see the financials and what we're doing. So it really just depends. Some of the deals, like the investors, when deals would fill, like when we could buy more acquisitions and they're available, deals would fill very quickly, and you would get nervous because the investor wasn't reading the business plan, right? They're just trying to get in. Because their money's not doing anything. So that was something
that's not an ideal scenario, though.
Terrible. Right? Terrible. Like, we want them to know the story, because that only works when it goes up and it's good. And if there's any sort of thing, like, it just, as you know, the business plan draws a straight line from A to B, and nobody's hit a straight line.
Were there shifts that you made to that, like, plan? I guess obviously you outperformed, but how focused do you stay on that plan if?
We amend the CapEx. So like part of like putting yourself in a unit is you discover like what we thought we needed the first. Like we thought we needed new front doors and new windows. Well, no, those would have fixed visually, but what we need is we needed, unfortunately, new AC units. So we had to put 202 new AC units in, right? And that's like putting in a parking lot. Like, like people just expect that to work. But that's a big number. But we shifted that because that's a retention piece, right? If people are in their unit and their AC keeps breaking, like they're for sure going to move.
Sure.
If the window looks old or whatever, then maybe what we do is once we get cash, we put window covering. So we're yeah, you have to be nimble.
Yeah, yeah. All right. So, going back to these scenarios, where do you feel in the, like you mentioned you're looking for land deals or development deals now?
Mostly.
What markets are you?
Yeah.
Are you one of those, do you have to drive to it? 1 hour flight? What are the parameters? Because that seems like something you need to be really hands-on for, right?
I mean, for the development partners that I have, we have a partner with a group out here named Clark Whalen. So they've built, I think, nearly 40,000 units now at this time. So they're one of the godfathers of apartment buildings. And so the level
they'll teach you a lot just by doing. I mean, just being in those meetings. I know we did. The problems that present themselves is the best tuition,
right?
Sort of, in learning this process. How active are you in those development meetings? I know your management team, obviously, but
yeah, we're there. We're every single one of them. I mean, Clark Whalen has been, I'm a relationship person. So every company that I have or whatever, I literally have partnered with someone who has done it for a long time. And has the track record and the integrity and all the stuff.
Right.
And then what they have is they have all this knowledge. And so, and I'll give up a piece of that for that relationship. So for me to go to a market and do a development deal would be difficult, even though we're in discussions with some GCs in different markets. We're not there. The level of trust isn't quite there yet. So, because what's happening is if you look at, there's so much development, I think some GCs would tell you like, gosh, we're so busy. We have such a pipeline. We don't even know what to do. They get plans. They feel bad saying no. They mark them up 30%. They kick them back. And the developer's like, cool, let's do it. And they're like, what? So I think that's, again, there's huge demand there too. So we got to have just relationships that are going to withstand all sorts of different things.
Yeah. Where do you get lost in the deal? Like, when you look at a deal, where do you get lost? Where do you pass, I guess?
I get passed on pricing right now. So like on this deal that we just made an offer on, there's room all over the deal, but where the market is trading is you're paying for the value add you're going to create before you buy it. And it's just, then it's a bid on who's going to pay for the most, part of the value add. So that's where I'll get lost, is that you're paying to take the risk, and they're taking too much meat off the bone.
And what are you looking at to determine that? So just in the assumptions?
Yeah, just the rents. So, you'll have particular deals where somebody has owned it for a long time. They're full, they're comfortable, they live off the yield. They're not pushed. They're passing the ball 5 times before they shoot, with rent type thing. So it's more of a defensive strategy. So there's some opportunity there. You'll see things like washer, dryer, low-hanging fruit, whatever type of value add, if that's the component. You'll see developers who might be developing, they have deal fatigue, right? They've had 400 change orders. They're exhausted. They're burning through money. Like, they're nervous. They don't have one renter. They're behind schedule. Like, we'll go there. But where I get lost is that, I'm typically trying to underwrite to a 7% cash on cash with, I don't even like using the term because everyone says conservative and modest. It's like, it's most, but I'm trying to run it to a 7% return that I'm extremely confident that we can hit, given some pretty core parameters.
Are there ever scenarios where you are sort of banking on the market?
No.
Other than, like you mentioned, the Scottsdale moves that, going to what, 500 a door? Never banking on the market.
No,
Do you see?
I bank more on the large REITs and where their capital's going. So I bank more on where I think the capital's moving, because I think that they'll drive market
As buyers.
And buyers. So
you need to develop product that would suit their.
And right now, you know, everybody. Phoenix is probably one of the hardest cities to buy in the country. I mean, there's so many people that want to get in, from all sorts of different spots. New York. Literally, today I'm meeting with a broker that's from New York that has a listing in Phoenix. Like, that's wild.
Right.
Right. And he typically does institutional.
That's a relationship play there, right?
Listen, he'll never sell. He will never sell me anything, but he'll have lunch and coffee with me, and I get to talk to him about his capital groups and what they're buying and what they're going. Like, that is coming straight.
What are you learning in those conversations? I guess
Yeah, that there's just so much supply, or there's so much equity. Mm-hmm. So here's also where I would say that we're focused at, is that the big REITs in this institution, they can underwrite market risk. Right? They can underwrite that market risk all day long. They can't necessarily underwrite development risk. I can underwrite development risk. So if I can solve the development piece, take that risk off, right? Deliver them a product, they'll pay you for the market risk. So in the case of, Prescott, the same thing. We built it. We took the development risk of building all of that. We solved that. Now a group came in, they're paying in, they're willing, and they can underwrite and pay a number that they can underwrite. They think that the market's going to go up or what have you, but they can underwrite that risk. And so that's where we're niching mostly is, I'll talk to this group today. That's probably where we'll go, is he'll be telling me about the market risk that they're willing to swallow.
Mm. And tell me about the development risk. Why is it the operating structure? You're filling that gap.
Yeah, you're building something out of nothing. So, in the case of Prescott, we built on
the cash flow.
We're on a slope, so you're blasting dirt. You could hit granite. You could, right now, you start hearing guys talk about refrigerators or electrical or plumbing supply. It's all gone up. Mm-hmm. You can underwrite the price. The price is the price. What you can't underwrite is if you can't get something because it's floating out in the middle of the ocean,
right,
for 3 months, and your loan's going like this, right? And because the minute you hit go, it's just everything's cost. So
it moves quick.
Yeah. So you have trades that when things go up. So think about a lumber guy. I'm not saying there was one, but if he guaranteed, if he did a fixed price contract at $1 a board,
sure,
and it goes to $9 a board, he didn't lock in his number, but he's promised to guarantee that, you could just start to see where things just start to, snap. Mm-hmm. So, yeah, there's just a lot more moving parts. I don't think development's for everyone, but
in the development process, are you asking those questions, like to the lumber team?
Yeah, but that's.
I remember we were dropping it. It was almost like a whole nother analysis just to buy that stuff, right?
Yeah, you used to be able to buy it like in the future, right? You pick lumber 6 months. Now you're literally buying it in 2 weeks. It's like you're on the, I'll take it.
And then where is it?
Exactly. But that's the GC. That's where from a development stuff, I will see development plans too. Syndicators, hey, have this guy. He was a home builder. He's whatever. We're going to go build 50 units or 100 or whatever that is. It's just a different it's just more moving parts. So, there's big contractors in town. They have the relationships. These guys have been doing it long enough that they don't really have any interest in not shooting you straight.
Yeah.
So it's just, can you afford it? Land prices are up, costs are up. So.
Right. Is there ever time? I know the development risk, like you mentioned, was it Prescott, the slope and everything, that you'll take on more risk in going in? Maybe even
I think each deal you do. Each deal.
Technically, yeah, right.
Yeah. I like the deal that we bought in North Scottsdale is we felt that, there was no land available, right? So if somebody was going to build or come compete with us, that they would literally be buying a product, tearing it down, starting over, and that their basis would be so far above ours, whatever. So we, at the time, every time we get a deal, I feel like we stretched too far, right? And every time somebody buys the deal, you were the highest buyer.
Yeah,
Most likely.
I remember. What was it? The one down in on Hayden. I can't remember what.
Well, the Winfield,
Yeah,
Scottsdale. Yeah,
wasn't that you were aggressive on that one too?
that broke the record. Yeah, when I bought it, and it might have broken when we sold it too.
Yeah.
But the bones were so good, and the community of who was going to live there made so much sense, and their income, and it just when you just reprofile.
So in a scenario like that, going in, it felt like you were taking on more risk than normal. I mean,
people thought I were nuts.
Right. So how do you move through that?
You just have to really know your customer.
Yeah.
I mean, we just knew who the customer was. I knew that this is their income. This is what they're paying now. They're paying 12 to 13% of their monthly income on rent. Like, I should be able to get that to 20 to 25% if I'm providing the right kind of value, the right kind of living scenario. So we had to make that thing swanky, and it had good bones, and it had, all sorts of stuff. And that property does phenomenal. Like today, our company still manages it. And that thing is, from when I sold it, has done fantastic. And there's still a lot left to go.
Yeah. And you mentioned the simple question, which was to your investor, if people had, rent, where are they going to go in that marketplace up in Prescott? What else? What are you looking at in the obvious? Rents below market, below replacement cost, recovering market,
renter affordability,
ability to renter affordability.
Yep. So, bless them. Each broker will tell you how much rent growth there is in every deal, right? You do this, you're going to get $100, and we're going to pro forma all that out.
And are you looking at that's the incomes?
Yes.
Or just the rent comparisons?
Yeah. So I'm looking at, if you see a business plan, again, if you really get in the weeds, if you're going to invest in a deal, that's another great question to ask, right? Like, so as you start to understand, hey, what's the average income of the renter profile there today? So
and then the mortgage piece too, because you could lose them as well, right?
Yeah, but what happens sometimes is people will say, "Hey, we're going to go spend X, why these people are, and we're going to raise their rent $50 or $60 at a renewal," but they're already spending 35% of their monthly income at rent. So when you raise their rent $40, like, it's drastic, they're going to move. Or you might have the case of where somebody's like, "Hey, they're making 80, they're spending 15." For $50 a month, like, it's not worth the hassle for them to move. And if you give them new stainless steel appliances, like, they're probably not moving. Like,
right.
So that's a better story. Or if it's low, then really what you're telling me is you're going to re-tenant, you're going to re-profile the property. So that means somebody's going to move out. You got to find a new one that makes X. You got to convince them this is where they want to live. So you're
looking at costs to do that, return the unit, cost to slip units on vacancy.
And can they afford it? Yeah, because and sometimes in your C and your B properties, people will move just on the principle that you're raising their rent. That's typically been the case. Now they're not moving, or it's really interesting. We'll see people like say, "Hey, my lease is coming up. I'm going to non-renew." They go out to look for an apartment. They come back and they cancel it. Like, I'm staying. Because they're like, wow, there's nothing there. Like, it's frustrating. Like, it's just as expensive. So, yeah, it's just know your customer. If your customer is going to find value in it, then it's going to work.
Yeah, no, absolutely. And market size, population factor into that, or?
Yeah, I mean,
I know we're talking about secondary markets later on in the show, but you obviously don't get, Phoenix being a large area.
I mean, we have stuff that's urban. That's a totally different profile of, the individual might be making $75,000 a year that, is going to live in a 650 square foot apartment that is going to get out of here a lot on the weekends and drive X and do whatever. Or then we have tons of stuff that we manage on the single family for rent, build for rent stuff, and what that demographic has turned out to what we anticipated would turn out, that's very, very interesting stuff. And so it's just, we're really present in what we're doing in all asset classes and what we're buying. And it just buying it and hoping that it goes up. It's worked. It's worked the last few years, but not an underwritable structure.
Right. You gotta sleep at night.
That's right.
What about the depth of that? And you're talking about incomes, affordability. Are you now going through what we just did with the profile of where the employee gets their income from what industries? Given that we just went through the pandemic, do you look at things differently?
Yeah, I think you have to. I mean, people are generating a lot of dollars from, necessarily not being in the office, which gets, we talk about the office all the time. I think office will become a place where I think people will go back, but I think it'll be a much more collaborative environment, right? Like we're going to come back, we're going to collaborate. Like the Zoom calls and, the culture and all that stuff that everybody creates, right, comes from this. It's very difficult in Zoom. Now, people are doing that, and that might be partially or what have you. So as we're talking about units and design, where, gosh, there was a moment in the 90s where everybody was kind of doing like a little desk for, a computer. Like you start to hear those conversations, popping up again. What we're seeing is 2 bedrooms getting leased like crazy, and one turns into an office. And, we've talked about the ideas of having, your apartment and then a place you can go downstairs and you can rent an actual office with an address that's furnished,
co-working
and whatever, just to get up and get out of the door and go. So, I think that all of that changes. I think the tertiary markets were the biggest benefactor of that, because people were able to get out of the city, go somewhere more sprawling, get a lot more for the dollar, and I think that they're going to stay for a while.